um, want to go over the Great Depression for you guys. I think in this video we're going to cover the causes of the Depression, and then look also at President Herbert Hoover's response and public reaction. Herbert Hoover was, I think, head of the FBI for some time, and then followed up and won the election after Calvin Coolidge decided to not run for a second full term. Remember, Calvin Coolidge came in and had kind of an incomplete first term because of the death of his predecessor, when he was vice president. And then he ran for election in 24 and won, and then decides not to run again. And so Herbert Hoover is going to take up the mantle. But we'll talk about his reaction to the Great Depression, and also the public's reaction, Hoover's response and the public reaction to that. So what I wrote a little more notes here because it can be a little bit complicated. There's a lot of things going on here. So go ahead and copy this, screen capture, type it out, whatnot. I go into a little more detail than this, but these are the main bullet points that you'll want to know about. So what are we talking? What's going on here? Well, we had this kind of epic stock market increase or development, right? Or the stock market was rising to new heights by 1929. And it doesn't seem like many people really knew what was going to happen. I think most people thought this kind of continuation or good times were going to continue forever. But there's a whole bunch of problems that kind of that we know now in hindsight that is essentially going to lead to a huge collapse. Now, when most people think about the Great Depression, they think about the stock market collapse. And I'll go ahead a slide or two, and you'll see where you can see this huge increase leading up to 1929, and then this precipitous decline of Black Tuesday. There were several steep declines that were kind of scaring people. Then you get to Black Tuesday with this huge decline, and people start to kind of feel like there's something wrong. And of course, you can see it continue to decline all the way to a market low in 1932. Now, most people, when they think about the Great Depression, they see, oh yeah, it's synonymous with the stock market crash of 1929. But that is not the case. That's not the definition of the Great Depression. The Great Depression is not the stock market crash. The stock market crash was essentially a symptom, right? It was a sign of the troubles the American economy was having, and it was a symptom of some other things. So let's take a look at some of those symptoms. For one, the United States, through the Fed, had a really loose monetary policy, meaning they were keeping interest rates fairly low for probably much too long. When interest rates are really low, it's easy to get loans. If an interest rate is low, people will want to take out loans because the money is cheaper to get. And so people are going to start making maybe a little more risky loans, or maybe invest more than they should. They might become what's called over leveraged, right? They may have too much debt. Not everybody was doing this, but on the whole, in the entire economy, consumers and businesses were over leveraged, right? They were borrowing too much, right? There was what we might call an unsustainable amount of debt. Like I said, both corporate and consumer. So your average individual taking on too much debt, perhaps to buy these new material amenities, that were being produced by, this booming economy, right? Cars, radios, refrigerators, all those things. People were buying on credit. There were banks and other institutions giving kind of easy credit, just loaning people money that it was probably not prudent for them to do. So on either side, not prudent for the consumer to take and not prudent for the investor to loan. You just got a lot of people spending money that they don't have. But the idea here, if we go back if you take a look before leading up to 1929, people just thought that the economy was never going to fall. It was going to, it was on an upward trajectory. And we had kind of left the recessions and depressions in the past and the panics, that somehow the United States was beyond that. We had solved those issues. It's in some ways a hallmark of the progressive era and this kind of optimism of the 1920s, which is mankind can do anything and can fix anything. And perhaps we've gotten to the point where we have basically we've understood the economy, and we're never gonna see bad times again. The problem with that, of course, is, well, it's just not true. Let's take a look at why. Right, you've got the insane amount of debt, corporate and consumer. And what that does is lead to overproduction, not just in manufacturing for items, that consumers might buy, but also for other industrial businesses. You basically have some strange market signals that kind of indicating throughout the 1920s that people are buying, and in reality they can't afford it. And so one day, it can't go on forever. So one day something's going to happen, and people are going to realize that they're over leveraged, and the market's going to react to that, and it's going to react pretty dramatically and precipitously, as we see in this precipitous drop on Black Tuesday, which I believe was in November 1929. In any case, right, you've got overproduction, not just in manufacturing, but also in agriculture. We'll talk about that. But then by late 1929, you also have a decline in both foreign and domestic, in demand of both from foreign and domestic sources. So specifically foreign from Europe, demand from Europe started to decline. And it was also met with a decline in 1929 from consumers, right, who were over leveraged and simply they were maxed out on their credit cards, or, so to speak, right? They could not borrow anymore. And so as they stopped buying, what companies realize, right, that demand is declining, they need to cut back on supply. And to do that, right, you fire workers, and you simply don't make as much. Now, if you're not making as much, and obviously you're not selling as much, you're not making as much money, you're gonna lay off workers. But what that's gonna do is increase unemployment. And so you'll get increasing unemployment during this time. And we start to see this is where we start to get into a cycle, right? If it's the reverse cycle of what we saw in the early 1920s, which is demand is up, sales are up, so corporations and businesses hire workers to create more and increase production. Now, the fact that they're hiring more workers and paying them means that there are more people out there in the economy who have money to spend, discretionary or whatnot, and they're spending more, and thus that increases demand, which increases the corporation's sales, which means they're going to hire more and produce more. This is the opposite. If you lay off workers, those workers who used to be getting a paycheck now are not getting a paycheck, and they're not buying. Right, at the very least, their discretionary income is now declined substantially. So, the very least, they're not buying luxury items and whatnot, and even that is going to create kind of a contraction in the economy and cause businesses to reduce production and thus fire more workers. But a lot of these people, it's not just that they lost their discretionary income. I mean, they're losing everything, and they lose their houses. And so they can barely survive. So it's not just discretionary income, it's that necessary income for buying food and paying rent that people are not able to do. And that's really bad, because that also is going to contract the economy, is going to lead to a further contraction in the economy. Then, of course, we get to the big sign of all signs, right? I mean, the one that everybody kind of looks at, to where, and it is significant. It's not just that the stock market crash was not one of the causes. It is sort of a cause. It's a symptom and a cause. It's a cause in the fact that people are going to realize, it's a very visible sign for people. When the stock market crashes and takes such huge dips, people recognize that and start to become afraid, which contributes to, right, the overall, such a fear can contribute to a tightening of credit and in any number of ways, and can further exacerbate the problem. So you get this huge market crash. It's actually in October of 1929. I don't know why I said November. I should have known it was October. Right, and part of the problem here, again, there's more to it than just the stock market crash. The problem was it had to do with people being over leveraged and taking on too much debt. People were doing what's called buying on margin. They would buy a stock. They would say there's a stock in a company and one share is worth $10, right? So to buy that stock, you have to have $10. Well, there was this kind of wiggle room and kind of loophole where investors were being offered, or buyers were being offered, the ability to buy a stock on margin, meaning they might only pay 10, 20, 30% of the stock's actual value, or the share's actual value. So instead of buying the stock outright at $10, they might buy it for $1 or $2. Now, keep in mind, this is dangerous, because if you buy the share, even if you're buying it for $1 or $2, you're still you still owe, or you're still in on the whole $10. It's like you're putting money up front. You're only using $1 or $2 at first, but you're still owing. You still like take $10 into debt. But the thing is, people normally at the time they thought that, well, the stock market's only going up. So if that share rises to $20 a share, which stocks had been going up for a long time now, then ultimately you may have bought the share for only $1 or $2, but then if it's now worth $20, you've essentially made $10 on top of that, and so you've essentially made almost all the profit without putting as much money down. But there's huge risk to this, because if the economy collapses and say you buy one share of stock at $10 share and you buy it on margin for $1 or $2, and that stock collapses, not only you're not just out $1 or $2, you're out $10. That extra $8 that you didn't have, and so you're out that, and that's what happens in the stock market crash. That's why it was so bad for so many people, because they had bought on margin and didn't actually have the money to pay for the stock. So when it crashed and the stocks aren't going back up, they can't pay for it. And so they're going to have to consolidate or liquidate other assets. Or if they don't have anything, then they're bankrupt. They're out. They won't be able to pay their mortgage, then they're kicked out of their house. And so that's a big problem for a lot of people. So again, the idea that the stock market was only going to ever increase, the idea of speculation, right, of believing that, speculating that the economy would do well or certain stocks would continue to do well forever, that kind of speculation is another, I guess, cause, right, combined with this buying on margin, this taking on of too much debt. And so after this, right, we can see here, right, I just like this image. It's really interesting. Nice fancy vehicle. Guy who basically said he lost everything and he's got to liquidate his assets because he's probably got no way to pay off what he owes. I would assume that this gentleman probably or may not have had this car paid off. Of course, I don't know how he would sell it in that case, but he's probably looking to liquidate his assets because he knows he's lost a lot of money. We also get to, right, collapse in banking, right? It's not just individuals or corporations who had invested in the stock market. Banks did this. There were a lot of banks who were pretty conservative with their investing, but a lot of really, really big banks were fairly risky, and they were also the ones offering these people to buy stocks on margin. So they're making risky loans, and then when the stock market collapses, they can't secure or maintain their reserves. And so when people go to get their money out, which people are doing because they've got to pay a lot of debts now, all of a sudden they realize there's no money in the bank, and which leads, of course, as we all know, to a run on the bank. And of course, if the bank doesn't have the cash on hand, people are going to lose faith in that bank, and it's going to go under. So banks start to fail, and the more banks that fail, the more businesses that fail, and the more businesses that fail, the more banks that fail. So it's this cyclical kind of snowball effect that just keeps getting worse and worse. Right? Not to mention, if a bank fails, if you didn't get your money out of there, it's gone. There are a lot of people who lost everything. Maybe they had made conservative investments and weren't destroyed by the stock market, but they had invested and saved their money in the wrong bank. And so a lot of those people, sad to say, they lose just about everything too, and they're going to lose their homes most likely because they don't have anything. They can't get to their money in the bank because, quite simply, the bank does not have it. Again, banks don't keep your savings on them at all times. Which brings up another point. There's not a whole lot of regulation in the banking industry at this time, and that will change with the Roosevelt administration that comes in 1933, after he wins election in 1932. So, right, that leads to increased employment, and so we see the cyclical effect. Let's take a look here at the kind of flow chart. Right, we've got automobile sales declining because of loss of demand. Keep in mind that all these industries are connected to each other. So if auto sales are declining, that means that, right, the textiles, or the leather or cloth components to that car, companies like Ford Motor Company and General Motors, they're not buying as many textiles, and people aren't buying oil or gasoline, right, to put in their cars, and steel that these cars are made out of, and the rubber, all that stuff. If demand for cars go down and these producers cut back on production of cars, that means demand for all these other elements in society or products in society are going down. That causes a slowdown. It causes lower wages and unemployment, which then contributes to further decline in sales as we start all over again. So there's some stuff over here that I didn't mention yet. We'll talk about high tariffs, uneven distribution of wealth. I guess we can talk about uneven distribution of wealth now, because I'm not going to say it later. A lot of economists have noted that there were some very, very wealthy individuals, and the middle class was probably not as wide as historians might have, or economists might have wanted it to be. And the problem there is that if you've got a lot of wealthy and a lot of people on the lower end, and wealth is not distributed evenly, there's a huge gap there. That means like an event like this depression becomes really bad, because you've got a huge number of workers who are going to be unemployed, and that growing number of individuals on the lower end, they're not going to be able to contribute money into the economy, right? That consumer spending is not going to be able to stimulate the economy. The wealthy can only do so much in spending their money. In reality, there are a lot of other people who it would have been nice to have make a little extra money so they could essentially keep consumer demand up. But that didn't happen. Looking next, we see income and spending overall in the United States on the decline, right? People aren't spending, producers aren't going to produce. And that's part of the cyclical element we're talking about. In terms of exports, we see the substantial decline. Looks like probably more than half. More than half between 1929 and 1932. So exports are declining. Now, there's something else to that too, and it has to do with tariffs, and we'll talk about that when we get to Hoover. But also decline in demand from Europe, which we kind of already mentioned. Europe was going through its own issues. And then they're going to be hit hard by the depression that occurs here, and we'll talk about that. Where's that other post? Okay, so before I mix that up, before we get to the Dust Bowl, I want to talk about just some numbers here so you can see, you can at least read kind of what's going on here. During the Depression, what you see, right, industrial production declines by 37%. Construction declines by 78%. Prices of agricultural products decline. I'm not sure why there's not a number there. Maybe I deleted it accidentally. Consumer spending declines 18%. Consumer lending declines. Private investment declines a whopping 88%. And corporate profits decline a whopping 90%. And employment, of course, rises 25%. So just to kind of put some of that stuff in context for you guys, if you can remember any of these for a DBQ, if you have it, or just to know, just so you can see how much of a problem this was. I don't know. The numbers kind of speak for themselves. Another thing I want to throw in here is the Dust Bowl, which is an element we want to talk about because it gives kind of an understanding of why this was such a terrible time for so many people. Not only do you have farmers, right, going into bankruptcy, I don't know if I get it here yet. Oh, before I get to this, one last point. The Depression is going to spread to Europe because, you know, as the United States is basically losing its shirt in this Depression, credit is going to tighten, not just for consumers, but actually for Europeans. If you remember, right, the Dawes Plan from the mid 1920s, when the United States was lending money to Europe to help Europe pay off their debt to the United States. Basically, you know, given the Depression, the banks and the federal government are going to be less willing to lend to Europe. And when that happens, it means credit's drying up, and then European governments are not going to be able to pay their debts, and so they're going to default. So they're not going to pay their loans back to the United States, which of course is going to make the Depression worse for the United States. But it also means that Europe is now going into its own depression. Europe's won't be quite as bad as the United States for various reasons that I don't recall off the top of my head. Maybe you remember from Euro. But suffice it to say, for U.S. history, it's worse. It starts in the United States, spreads to Europe, but it is worse in the United States. It is far deeper in the United States than it is in Europe. One problem, because I want to get into farmers and talk about the Dust Bowl, is that farmers are hit pretty hard. I think a total of 1/3 of all farmers lost their land, lost their farms during the Great Depression. So between 1929 and 1932. Now, the way I phrased that was a little off. The Depression continues beyond that, but the quote about 1/3 of farmers happens between the 3-year period. And so that actually has some consequences here. If you remember about the Great Plains, right, where there are a lot of farmers, the Great Plains, of course, are plains, and there are grasses that grow there. And the grasses that grow there are pretty deep-rooted than the natural grasses that grow there. But for almost a century, farmers have been using steel plows, and that steel plow is what made farming possible in these areas, because those deep-rooted grasses, they're deep-rooted because the plains don't get a whole lot of rain, or the rains are intermittent. And so it's really tough to break through those. But with a steel plow, which is much tougher than any other metal any farmer has ever used, you can till the soil and dig through and break up those roots. But the problem is, you break up those roots, they don't just grow back immediately. So if by chance, like, a whole bunch of people stop, like maybe they till the area over a couple of years and then stop tilling, you end up running to an erosion problem. And that's what happens in 1930. So in 1930, the plains experienced a pretty severe drought. So not only are you in the midst of a depression where farmers are losing their land, they stop tilling the land, and they're not planting any crops. And without crops, you have no roots to hold the soil in. And then you've got a drought. Well, you get some big storms that come in and essentially whip up all this dust and sweep it away. I mean, there's a story about a Navy ship off the coast of California that essentially had dirt from these storms that are occurring, as you can see in Texas, Oklahoma, Kansas, Colorado, Nebraska, South Dakota, right down these plains. If you want to take a look further, we see all these, each dot represents a farm or acres of cropland. And these are individuals that essentially, right, and in this kind of area, especially by Oklahoma, Texas, Nebraska, Colorado, that's where, or Kansas, that's where people are getting hit the hardest, and soil is being eroded. People are going to migrate west to look for jobs to California. And we'll talk about that again soon. But you can tell here, I mean, this is nothing to scoff at. I mean, people literally suffocated if they were caught outside in these storms. And you can see, right, a vehicle and just the devastation that can occur. So if by chance you manage to keep your farm and not go too much into debt, you might have lost it because you were swept up in the Dust Bowl. And the Dust Bowl was not one specific dust storm, right? The Dust Bowl is kind of it's a period in United States history, right, in the Great Plains during this drought, during the Depression. So it's not like a one-off storm. This happens, I believe, over several years. I have to confirm that, but at the very least, we know it starts in 1930. So we can see that's pretty devastating, even for farmers who hadn't lost everything. So what I want to move on to now is President Hoover's response and the public reaction. When Hoover came into office, right, he won an election in 1928. He comes to office in 1929. He takes a similar tactic that Coolidge had. So prior to the Great Depression, prior to the stock market collapse, he also, right, he's in this line of laissez-faire, keep the government out of the way, let the market do its thing. It's doing really well. Well, right, he runs into a problem with the Great Depression, but his goal, even during the Great Depression, for quite some time, for several years, he doesn't act. He doesn't call on the federal government to do anything. He kind of is a believer in that rugged American individualism. And a perception of the time was that, you don't want to be handing out money because you actually weaken people by doing that. So wrong or right, that was his perspective. And over a couple of years, people are starting to get a little bit upset with his handling because the Depression is not, the economy does not recover, which is a hallmark of the Great Depression. It didn't recover like some of the other panics and recessions of the past. But one of the problems with Hoover's administration, or rather the Fed in general at this time, was their inflexibility when it came to the monetary supply. So the Fed had basically made the mistake over the last 10 years or so of being too loose with monetary supply, meaning they kept interest rates too low. Well, the economists today, most of whom would suggest, no, you need to actually loosen up the monetary supply even more, give more credit, right, lower interest rates even more so that people have money to spend, and they don't default on their debts and don't go into bankruptcy, and you got to stop the cycle that way. But the problem is, it's not necessarily a problem with Hoover as it was the Fed in general. The Fed was worried about its own budget and could not agree on whether or not to lower interest rates. And so because they couldn't agree, interest rates for a time stayed the same, and the problem, and the monetary supply continued to contract because people are losing their money, or at the very least, it's not expanding. Not to mention that Herbert Hoover was a fan of the gold standard and wasn't willing. You can't just, it's not as easy to print money when the government says each dollar is backed by a certain amount of gold. Right? You can't print gold. You've got to mine it, and if you don't mine it, you can't increase the money supply, or at least you're restricted in doing such. Ironically, eventually in 1931, the Fed will actually raise interest rates, which I think most economists would agree is probably the exact wrong thing to do. But in 31, they raise interest rates, and that's going to create a problem, tightening monetary supply, making credit even harder for people to get. You've also got tariffs. We talked about this. Not only were tariffs already probably pretty high in the 1920s, but by 1930, you get what's called the Smoot-Hawley tariff. It was meant to protect farmers. Ironically, that's what farmers traditionally had wanted, are tariffs. But at this particular time, it was not a good idea to raise tariffs, because not only is demand from Europe already in decline, but if the United States is going to raise tariffs, it's going to make agricultural products more expensive for Europeans, and they're going to buy less, which means a lowering of demand for U.S. agricultural products. So this is especially bad for farmers who had essentially overproduced. And I missed this already, but we'll cover it here. The farmers who kept their jobs, because there was such a decline in demand for agricultural products, not just from Europe, but from at home, because people are running out of money and they can't buy as much food. And so these farmers who see a decline in prices because demand is declining, they individually, right, without kind of consulting, because farmers, there are a lot of independent farmers and they're not consulting with each other. Individual farmers decide, well, we're just going to plant more to cover for the decline in prices. Well, the problem is if most of your farmers are planting more in a time when demand is declining, right, you're increasing supply, which is going to, of course, force prices even lower. And so collectively, without even knowing about it, farmers are really making things hard for themselves. Now, of course, the farms that are going to be able to get through this are the big ones, and you're going to see a lot of, again, more lower income and smaller farms go bankrupt because of these events. So we've got the Smoot-Hawley tariff, and that's pretty bad. But then we've also got some other things happening here. Before we get to the Reconstruction Finance Corporation, I want to mention that at this point, the Democrats are starting to gain ground, right? Hoover's a Republican. We have the elections, why am I blanking? The interim elections, the non-presidential year. You guys know what it is. I can't think right now. Midterm elections, of course, in late 1930, and the Democrats take over the House at this time, and which is kind of indicative of a loss in public faith in Hoover, as if, so the public seems to be turning against Hoover, saying, okay, well, maybe we agree that the government shouldn't be over involved, but what you're doing is not working. And we start to see increasingly people demand that the government do more, because people are starving and they want the government to find a solution. And it's not always that they know exactly what solution they want. They simply want it fixed. And so basically the next 10 years, or at the very least 7 years, is going to be the government trying to figure out how to fix things, and people in general trying to figure out what's going to work. And when the people really focusing on the government doing the fixing. So we know that the public is beginning to turn on Hoover. And another example of this are these new shanty towns that develop, and what they're called. Shanty towns, right? People are losing their jobs. They can't live in the city. There's nowhere for them to go. So they move outside the city in these temporary structures that they build out of, whatever they can find. Basically really large homeless camps, and they're called shanty towns, with a nickname of Hooverville. And people call them Hoovervilles because people started to blame Hoover for this economic crisis. So we know that that's an indicator that people are starting to blame Hoover for these problems. Now, towards the end of Hoover's administration, his his term, he seems to he caves to pressure to basically get the government into the bailing out of industries and states. And he, in coordination with Congress, they passed in 1932 the Reconstruction Finance Corporation Act. Right, this is in January of 32. It was supposed, as you can read, right, it provides emergency financing for financial institutions like bank, for agricultural businesses, farms, whatnot, commerce, industry like rail, right? All of that was supposed to kind of bail out some of those industries and some of those companies. It had, I believe, it was given $1.5 billion to spend, which was a huge sum at the time. But they only spent about 20% of it by 1933. And so in the end, it was too little, too late. The Depression was getting worse, and we're going to ultimately get to the election of FDR. The only last thing I think I have on the agenda for this one, before we talk about FDR and the New Deal, is essentially what's called the Bonus Army protest. Just a signal of discontent and to show how bad things are getting for Hoover. Basically, in 1924, veterans were promised through an act of Congress, right, $1,000 for having served in World War I. So veterans are going to get a $1,000 check. But it wasn't to be paid until 1945. Well, with the Depression, you get a whole bunch of unemployed former veterans of World War I who start to demand, right, collectively in this protest group and movement, right, their $1,000 checks immediately. Hoover says no, and this particular protest group of veterans march on Washington, D.C. And they in June of 1932, and they end up camping there for about a month. By the time July rolls around, there's some skirmishes between police and the veterans, which kind of indicates or leads Hoover to believe that these individuals are radicals, right? And that they're violent, they're radicals, so they need to be like booted out of D.C. So he sends in General MacArthur underneath George S. Patton, whose names you might recall, you might know. And MacArthur basically leads troops and pushes this army protest out. By the way, in case I didn't mention it, it's called the Bonus Army. Colloquially, the Bonus Army protests and whatnot. And MacArthur pushes them out of Washington, D.C. They get roughed up a little bit, or at least the protesters do. About 100 or so of them are injured. And it's basically a PR disaster for Hoover at the end of his administration. He's seen as callous and not caring about, the veterans of World War I, right? And so he's seen as someone who doesn't care, who's not in touch. And so this is going to really harm him moving into the election of 32, which will be in November of 32. And so, right, that's what I wanted to mention there. Let's see if I can follow up with a discussion of the Great Depression, so you guys can be prepared just in case you get a DBQ on that. But chances are not likely. But I hope you guys enjoyed this this review. Take a look at that over those notes I gave you, and that'll be it.